There's a type of investor nobody talks about. No flashy trades, no hot stock tips, no staying up until midnight watching charts. They don't brag at dinner parties. They don't have a newsletter. They don't post their portfolio on Reddit. They just quietly, consistently do one boring thing and end up wealthier than almost everyone around them. Today, we're going to talk about why boring wins and why the smartest financial decision most people will ever make is also the one that feels the least exciting. Let's start with the belief most people carry around without even realizing it. The belief that to make real money in the market, you need to beat it. You need to find the right stocks before everyone else does. You need a strategy, an edge, a system. Because just matching the market, just going along for the ride, that feels passive. It feels lazy. It feels like settling, and nobody wants to settle. So people look for something better. They research stocks, they watch analysts, they listen to podcasts, they follow investors who seem like they always know something everyone else doesn't, and sometimes it works, for a while. Here's the problem. Beating the market consistently year after year, decade after decade is one of the hardest things in finance, not just for regular people, for professionals, for people whose entire job is to find better returns. Study after study shows that the overwhelming majority of actively managed funds run by highly paid analysts with massive research budgets fail to beat the market over a 10 to 15-year period. Not occasionally, consistently. The market is not easy to outsmart because the market is everyone. It's millions of smart, motivated, well-resourced people all trying to find the same edge at the same time. Trying to beat all of them every year is not a strategy. It's a gamble. So what does matching the market actually mean? It means buying an index fund, a simple investment that owns a small piece of every major company in the market. When the market goes up, you go up. When it goes down, you go down. No picking winners, no guessing, no timing. Just owning the whole game instead of trying to win it. And historically, the market has returned roughly 7 to 10% per year on average over long periods. Not every year. Some years are terrible, some are incredible. But across decades, that average has held remarkably well. That's the boring investor's secret weapon. Not a hot stock, not perfect timing, just time itself. Now here's where the psychology gets interesting. Our brains are wired to believe that more effort produces better results. Work harder, get more. Study more, score higher. Try harder, win bigger. That's true in most areas of life. But investing is one of the rare places where more activity often produces worse results. Every time you trade, you pay fees. Every time you try to time the market, you risk missing the best days. Research shows that missing just the 10 best trading days in a decade can cut your returns nearly in half. And those best days almost always happen during the scariest moments, when everything feels like it's falling apart and every instinct tells you to get out. The investor who does nothing during those moments wins. The investor who reacts loses. Let's make this concrete. Imagine two people. The first is Marcus. Marcus is sharp, motivated, and spends hours every week researching individual stocks. He finds good companies, he makes smart trades. Some years he beats the market by a few percent. Other years, he underperforms badly. Over 20 years, his average annual return comes in around 6% after fees and taxes from frequent trading. The second person is Diana. Diana sets up an index fund, contributes every month, and barely checks it. She watches the same movies as Marcus, she takes the same vacations, she just doesn't spend her weekends analyzing earnings reports. Her average annual return over the same 20 years is 8%. That 2% difference sounds small, but on $100,000 over 20 years, that gap produces roughly $60,000 more in Diana's account. Diana won by doing less. That's the paradox of passive investing. There's also something deeper going on. Investing triggers the same part of the brain as gambling: the anticipation of a win, the fear of a loss, the desire for control. When markets get volatile, our stress response activates. We feel like we need to do something, anything. Selling feels like taking control. Switching strategies feels like being smart. But in investing, that feeling of control is often an illusion. The boring investor understands something most people don't, that inaction during chaos is itself a strategy, a powerful one. This is why the boring millionaire is so rare, not because the strategy is complicated, because it's psychologically brutal. Watching a stock you don't own go up 300% and doing nothing is hard. Watching your portfolio drop 30% and doing nothing is harder. Trusting a simple plan while everyone around you seems to be making faster money requires a kind of quiet confidence most people never develop. But the ones who do, the ones who just keep going month after month, year after year, are the ones who quietly cross the finish line. So what should you take from this? Stop measuring your investment strategy by how exciting it feels. Excitement in investing is usually a warning sign. The best strategy is the one you can actually stick to through market crashes, through FOMO, through every moment your instincts tell you to do something dramatic. For most people, that strategy is simple. Consistent contributions, low-cost index funds, a long time horizon, and the discipline to leave it alone. The boring millionaire doesn't have a better stock picker. They have a better relationship with patience. And in a world obsessed with shortcuts and overnight wins, patience has quietly become one of the rarest and most valuable financial skills alive. The market doesn't reward the most excited investor, it rewards the most consistent one. And consistent is just another word for boring done right.